Do you want to learn how to beat the stock market by building algorithmic investing machines? Well, today I'm sitting down with one of our master architects from our Discord who's been building machines for about 6 months now, and his portfolio is up 10%. The strategies you're going to see designed today were built with a software called Composer. I'll be leaving a link below, and if you're not a part of the Discord yet, you should be, because we have these calls every 2 weeks where you can learn more about building algorithmic investing machines. There'll be a link below, but let's jump into the video. All right, what's up, man? So let's start with your current version that you're running live, and let's check out the performance and everything on this strategy that you've been building.
Okay, so this is my portfolio since really about like Jan 15-ish, 17-ish. I'm up 10% so far for the year, and basically I would say 80% of my portfolio is concentrated in Dragon related stuff. So the performance of my portfolio pretty much looks like that.
Okay. How long have you been on Composer and on the dashboard? Because I know we didn't start tracking the actual performances on the charts till January, but a lot of people were here before then.
Yeah, so this is my start. This is my Composer start right here, January 17th. I started a couple days earlier, and then I added a couple grand.
Okay, so you were through the bull or the bear market, and you were still doing good. Looks like you had a pretty good spike there for a minute. Was there a particular strategy or anything on that?
No, so this was, if you look at Dragon 2, this is what it looks like basically. I was,
Okay.
my main combination was Dragon 2 and Adaptive All Weather.
Do you want to jump to the discovery chart or the discovery? Show the basic Dragon portfolio just so everybody is familiar, especially the newbies, because there's some common portfolios like the Dragon and the Buffett and
yeah, no, I can also go into explaining the reasoning and the logic behind.
They redid their dashboard. There it is.
Okay, so this is the Dragon portfolio. I'll explain my reasoning in a second, but the overall idea was to combine structurally different risk premiums, uncorrelated strategies, both convex and positively convex and negatively convex, to basically, improve risk-adjusted basis returns and also geometric returns, lowering drawdowns and whatever. So I think the portfolio itself is, 1/5 long vol, 1/5 trend following, 1/5 fiat alts, which is it's really just gold. A fifth, growth beta, and then a fifth fixed income link.
Okay, can you scroll down and show like the whole thing? So we got long volatility, VIXM, US dollar fund, trend, Australia. Okay, so you're exposed to emerging market, or well, I guess that's not emerging market.
Yeah, so there's developed. I think they're all developed markets, but their version of trend combines both commodity trend and all these developed market trends. You'll see in later versions I cease to use it, but it's cool. It's not a horrible idea. So you got France, UK, Japan, etc.
Yeah, I find with the different countries, markets and stuff, you have to basically design an individual logic for every single.
No, I agree. Right.
They move. Each one moves differently. Like Brazil moves completely different than Australia, and vice versa.
These are a function of those markets. Everyone has a different standard deviation. Everything has different risk parameters and different triggers, and you definitely need to fit the logic to the specific market you're trading, but at the same time know that a lot of these things are similar, especially growth markets. But I
would love to get the community challenges back up and rolling, like the monthly challenges, to where we can who can build the best Australia strategy, who can build the best fucking Brazil strategy, and then we can diversify the portfolios, and we'd have actual logic that works on each nation.
Yeah, no, I think that'd be very cool. Like a leaderboard, we can see who's performing well and who's everyone's favorite builders in the moment.
Yeah, we're talking about it in the back end. It's I want to push the community forward on a lot of this stuff. All right, so you got gold, and then on agriculture, you're exposed to commodity.
Right, so their version of commodity momentum is really short-term cumulative returns versus IEF, which is I think it's 7-year treasuries.
Mm-hmm.
Yeah. The treasuries. So they do ags, gold, metal.
If Derek watches this, it'd be interesting to see if he could figure out a sort function, like his short strategy for the long term. If you could build a strategy for commodities off of that, where you rotate between bonds instead of using an else function, or an if?
So that's what I do with my transactions. Nowadays I use 60, 120, 180, and 240-day cumulative returns. And instead of doing commodities only, I personally just like to do S&P, TLT, GLD, DBC, UUP, and 3-month T-bills.
Hey, are you enjoying this video, but you're a little overwhelmed or confused? That's totally normal. Algorithmic investing can be kind of complicated when you first start. I've been doing it for a year now, and I remember what it was like. But to help you out if you're a new person, I've actually started a newsletter to help educate you on the best strategies that are performing and show you which ones are making actual real money. So if you'd like to learn more about these strategies and designs and how they work, check out our newsletter and you will get access to the best strategies and their actual returns. You can also find this information on the Discord in the newsletter channel.
Okay.
Follow momentum on those. And then the rest is, it's very clear cut. There's only really 5 asset classes in the world, arguably a 6th, which I'll get into, but you got credit, currencies, commodities, bonds or treasuries, and you have equities. Credit is kind of like diet equity. Credit has that growth component. But the 6th arguably is volatility as an asset class, which I can get more into. But with volatility, you're isolating, especially if you're trading VIX ETNs. It's a variance swap. So you're trading both the convexity and the skew of the option term. And so basically it's not only the at the money implied volatilities of those options that can raise the VIX. All the at the money stuff can raise it. If the vol is high, VIX can go up regardless. And it's also a function of realized volatility.
Yeah,
so that itself is an asset class, arguably.
Yeah, there's a lot to the VIX and volatility. Okay, so let's switch over to your version 2 and kind of walk through the logic. But before then, how'd you get into investing? What's your background? And you literally just got into algo in January.
Algo specifically, I like to think of it as systematic. I'll get into that in a second, but my initial background is derivatives, really just listed futures and options. So commodities, all the currencies. I trade a little bit of ags, energies a lot, and indices, obviously.
Mostly options. You said you off the recording. You said Tasty Trades was you were following a lot.
Tasty Trade definitely got me into understanding the Greeks and thinking in terms of functionality in the first place. I wanted to be a seller of options. That's something that made sense to me. I akin it to insurance selling. You want to sell umbrellas when it's raining, but
were you doing a lot of spreads? A lot of
Oh no, so really strangles, delta hedging every day. I was keeping some short delta bias because if volatility were to expand, it would be if the market was falling. So the problem with the short delta exposure is gamma will pick up on you really quick, right? And so you need to keep some short market exposure while being short volatility to buffer the volatility expansion.
Okay, so you're essentially hedging.
With those also, I was going farther out in tenors. So I was selling further out, like 60-day options, because, less of that.
Yeah.
Like the acceleration of everything, really.
Yeah, less decay. I only mess with options briefly, but I found that selling, if my time window was like 2 weeks, I would get into something that's like 3 months old, 3 months long or something like that. Okay, so how many years ago did you get into options? When did you first pick up stock?
Yeah, so I'm 21 now. So when I was 17, so about 4.5 years ago, if someone told me, these things have time value, and I was like, time value, what the fuck is that? I don't understand what that means. But I started reading about it, and you start understanding, and at first you're like, you read the formulas and you kind of get at a high level how these things are priced and how the individual pieces are all moving together. And then you eventually start to see it as just a probability tool, right? Mm-hmm. These things are priced in probabilities. And if you look at the broad spectrum of it, you can see it, literally you're trading some type of distribution. So you can isolate certain parts on that curve, but
I can see where your dragon portfolio and what you used to do kind of connects. Right. It's about probability.
So I love reading. I have strong opinions about, what managers I like and which I disagree with, which I think is important in terms of having your own actual opinion.
Managers as far as hedge fund managers?
Yeah, hedge fund managers, institutions, researchers, people I respect and I follow, and I hope to
Who do you respect the most, and who do you not respect the most in hedge fund managing? Not to put you on the spot.
Oh,
Who do you like the most? Who do you not like the most? Who do you study?
So in terms of like people who were instrumental to where our like understanding of markets and portfolio theory, obviously Harry Brown, what's his name? Chicago guy, this 5-factor model. Blanking.
That's okay. If you can remember at the end, 5-factor model.
No, Eugene Fama. I don't know. I'm blanking. But those guys led the path forward. So really can't miss out. But nowadays, Cliff Asness at AQR, Corey Hofstein, they do a lot of things. They're big on diversification with different style premias, and you can get into what a risk premium is itself, and why you need diversification. But
so did you? So when you got into algo, have you jumped into studying algo hedge funds, or like right out like Jim Simmons?
So I read a lot of EQD, research affiliates, all these systematic investors, and they're all really doing the same thing. Nothing is reinventing the wheel really, and so I don't focus too much on implementation. I focus more on goals, and I fit buckets because I understand, or at least I hope I understand relationships and macro market structure.
You've definitely got a deep knowledge of this stuff at 21 years old. You're way ahead of the curve for most 21-year-olds, especially me when I was 21. But all right, let's hop into your V2 and like walk me through the design. And for everybody that's watching or watching on the recording, Sandy will probably be on a few times because he's got multiple versions that he's evolved through the months. So it'd be interesting to like see his evolutions and like what he first found out and what's working now between those different strategies. Your follow page looks like my follow page.
I built so much stuff.
Yeah, if any developers watch this, like let's get the follow page.
Yeah,
give us a list version.
As this, please. Organize. I can never find anything. I have a sense like where this thing is, but
does anybody have any questions for Sandy while he finds his strategy? Do you want me to send you? Well, you sent it to me, didn't you?
Oh, no, I should just open.
Yeah, just pull up Discord and it's on there. Wyatt asked, could you give an estimate on how much of the overall strategy is based on counter-normative ideology, the managers you believe in to be wrong? That's a really good question because a lot of investing is counterintuitive.
Yeah, right. So if you think of trend following itself, it's kind of counterintuitive because you would think normal investors would want to buy what's low and sell what's high. So there is a lot of biases in the underlying strategies, but in terms of overall diversification, I don't think anyone can argue that. I mean, that's just it. That's what we live for, or at least I live for. So a lot of these things, I hope that they're really static allocations to certain assets and asset classes. I don't need my logic to trigger every day, but we'll get into it in a second. But in terms of managers, yeah, I have strong opinions as to, like, I don't love everything AQR does in their implementation, but I love their overall ideology, right? So you don't need to have, you need to come up with your own ideas. You need to have your own opinions. I think it's very important.
Yeah, education and knowledge is like the critical factor. That's where I come up with all my design strategies, is just expanding knowledge and learning more and more and more. And that gives me ideas on design. Michael also asked, is V2 your favorite version?
We were talking, okay?
That's good, thanks.
No,
you're hot micing.
I think 5 would be my favorite version. 2, I didn't build too much of the logic myself. I really had a goal. I fit everything into, I said, this has a purpose, this has a purpose, and I put it into each bucket, so
you started with the framework and just tweaked it.
It works very well. It works like it's supposed to, but it's structurally flawed in the terms of overlapping logic and the specific ETFs I picked in the first place. A lot of them aren't fractionable, which makes it hard to track.
Yeah.
But no, it is exactly what it's supposed to do. I mean, it's the essence of a dragon portfolio.
So let's start with your let's see what you're holding right now today, or what's currently.
Oh, it's gonna look a little crazy.
Yeah, so
Most of it is the momentum sections. So all the really small allocations.
Okay. Yeah, I wish we could see like actual sector weighting and stuff, like how much is in what sector and the leverage and all that. That'd be a great graph to visualize. So you got BTOL in there as well.
Yeah, so we can go through that.
We don't have to go ticker by ticker, but I just wanted to see like through the tickers. But okay, let's hop into the logic. The first one's volatility.
So long vol, the goal is you're basically hoping to profit from a move outside the normal standard deviation. So it's that fast move down that you're really trying to cover. There's better logic to do this, and you can add different logic layers to diversify, but this was my first start. I built the two parts of it myself. One is it's checking for, by the way, this is arguably overfit. This drawdown just worked really well in 2020, so I used it. But if 4-day max drawdown of SPY is greater than 6%, and I'm making sure that UVXY didn't explode already 500%. If it did, I'll get into UVXY.
Okay.
I'm not going to buy, VIX when VIX is at 50. I already missed probably most of the move.
Yeah, I wish we could dynamically adjust our if statements with like volatility, because volatility does change per year.
Right. It's stochastic. So it tends to cluster in certain regimes, and it pops and then it reverts, and it actually clusters at high and low levels.
If you look at the one day cumulative returns of any asset, you can see like the band or the noise, the frequency of the movement based on the regime. So so if you're into UVXY, if it's less than
and then if not, I'm holding gold, 2-year treasuries, basically currency swaps, and then common FAR similar to DBMF, but it's really more long only momentum on commodities. But I would say I'd much rather hold that than hold DBC outright. And then the other part is the attempt is market neutral beta, so some sort of alpha. C-Core I know does no cost collars on dividend names, and FTLS is just a long short, 0.5 beta ETF. So that's like 99% of the time I'll be holding this basket in the long vol section. I do the same thing. This is just a second L statement, right? So if the drawdown is greater than 6, it'll check this. If UVXY's cumulative turn is less than 500%. If both those things are true, then it'll get into UVXY. If UVXY already exploded, I'll get into this first basket, and in the same basket if SPY never had a drawdown in the first place.
Okay. I wasn't familiar with those two tickers. I'm looking at FAR right now as well as COM.
So I actually like both those ETFs. I like the managers, but that's another consideration also, right? So FTLS, COM, FAR, these are single manager risks, right? So that's a whole other thing you have to worry about to take on.
So there's only one person managing it?
It's discretionary in the sense that they chose what assets will go in their basket based on their own system versus an index. Like DMF also has single manager risk because they're a replicate, right? So they're lagging whatever SocGen trend or CTA index by a week, and they don't have the proper allocation.
So you've really done your homework on the tickers that you're putting into your strategies, and
what they're doing.
Yeah,
I know what they're holding, and I know what they're doing. Now FTLS holds probably like 200 or so tickers. Now I'm not going through them, but I understand their goal. They're going to be long momentum, and they're going to be short growth beta.
For newbies that are getting into algo design, what do you think like the most important thing is to look into when it comes to tickers, besides like fractional and K1?
Everyone's first thing is performance. Performance is very important. Obviously that's the sad truth about this industry is that if you're not doing well, you're not going to be given money. I think understand what the ETF is doing, go through the prospectus, go through the fact sheet, know what their goal are, understand what institution is actually managing this product. So certain institutions have certain reputations. I don't know. It's hard with ETFs because in the mutual fund world, you can have thousands of different managers to choose from. ETFs are, they're all going to be BlackRock or
Yeah,
Invesco. They're
true.
all this.
What do you look for? Like you look for exposure and
Yeah, I look for exposure. I have a goal, something in mind, and I say, what can I get that approximately fits this? So back in the day, I was building portfolios that resembled AQR's multi-asset portfolio in a sense, where I was taking a bunch of different style premiums. So whether it was the value factor or momentum or quality profitability or merger arbitrage or some kind of carry strategy, whatever it is, all those different premiums diversified together. I was using FLSP, FTLS. I was using common FAR for momentum. I was using all these ETFs and single managers to just rebalance that portfolio.
okay. What's the next part of the logic?
So the next part is,
Oh, you've got my volatility hedge in there.
I remember I try to find logic that fit my buckets at first. So I personally don't use this nowadays, but it worked in the sense that it somewhat makes sense. The fault in it, in my opinion, is it relies on the bond logic later on,
Okay.
at least aggressively.
Yeah, I haven't used it too much.
Well, the past 2 years, like in that 2-year regime.
Yeah. Show that weakness there. Let me see
I'll get into it. But first, it's if UVXY is positive over the past week, then I'll get long VIX because there's a reason for that somewhat. And then it'll check if not that, if TLT hasn't had a drawdown, let's just get long, mainly treasury exposure and a little bit of S&P. And then it's, if TLT is strong, it'll get long aggressively bonds. And if not that, UVXY, if it's strong also, again, it's a little repetitive. It's a little path dependent in the sense that some of the logic will only trigger if some of the logic didn't trigger. And I also don't like holding only bonds as an alternative to just being long vol.
Okay, so you prefer volatility over bonds?
Well, if I were to hold a basket of things to hold when I'm not positively convex, I'd rather just hold lower duration, and just a basket of other ETFs, gold, the dollar, shorter duration treasuries, maybe some trend exposure. Like I'd hold that basket, it would just be a lower standard deviation. Because the goal for long vol is to not lose as much carry. So you have 3 choices, the 3 C's really. You have carry, convexity, and certainty, and you can only really have 2 of them. So carry is, think of anything that makes money majority of the time but loses a lot at once. Convexity is the opposite. You really don't make anything most of the time, but when you do, it accelerates. And certainty is, think of like the S&P. For certainty, in 20 years you're going to be up on the S&P. That's the assumption we all make, right? Yep. So certainty also has to do with diversification and the probability of success in that year, right? So for every year you want to be up, that's certainty. So when you're holding a diversified basket, you're really getting certainty and carry. And then you can mix in convexity with doing long vol stuff. So
I got a question on what you just said. I'm interested to hear your thoughts since you have a pretty diverse knowledge set on a lot of this. So oftentimes the common assumption in investing ends up being, what was the last C that you said?
Certainty.
So certainty, everybody's certain in the S&P 500. Everybody was certain in housing in 2008. Everybody's always certain. It's the thing that bonds are always certain until they're not in the crash this year. What's your opinion on counterintuitive, certainty? Because certainty can turn into convex, where you have
so I think that's why finances is social science, and the models never fit perfectly, and you can't rely too much on the math. For that reason, I love the highway analogy, where the there's a $100 bill lying on the highway. The cars are trying to hit you basically, and you want to run onto the highway and grab the $100 bill before you get hit by a car. The trick is the speed of the cars is like the riskiness or the volatility in the markets. And other people are also running for that $100 bill, but you have to know there's a reason for that $100 bill laying there. So what we do with Composer is we try to, gauge the speed of the cars and gauge the profitability of other people who have been running onto the highway and gauge all these different things that you can test the weather. Basically, you say if it's sunny outside, I'm going to go to the beach.
Yeah.
And so the certainty aspect is really the underlying asset classes you choose, right? So if these are known risk premiums or things with, just steady cash flow, I'm going to prefer those over some kind of manager or strategy or BTAL or whatever it is that I don't fully want in my portfolio.
Mm-hmm.
But adding the two together can improve the geometric return.
Yeah. Yeah.
So not everything needs to have the carry component. That's the convexity component.
Yeah. I like to design, my personal philosophy is basically momentum off of the convexity and the carry. And then when also prevent the certainty. So like having some kind of logic that's designed in there. For example, I've been studying Ray Dalio a lot, as well as Peter Zahan, and been getting into birth rates and death rates a lot in the United States. And I've been studying Japan's collapse in the 90s, and China should be going the same way. And, the certainty is the S&P 500 is always going to go up, and it's always going to be profitable. And, the past 100 years of the US is going to be the next 100 years.
Right.
I don't know if I believe that, but I want to make sure that my algos are designed around that as well. Because, we
and the truth is we're not, we are overfitting to this past 40, 50, 100-year regime. The S&P has changed a lot. Think about how many publicly traded companies there were 20 years ago, and then think about how many there are today.
Yeah, and most Fortune 500 companies only last about 30 or 40 years, 50 years usually.
Yeah.
So would you say you lean more towards understanding people and understanding macro versus data and numbers? And
no, I can't say that. I say I like to use them together. Definitely not the social aspect, the cognitive bias aspect. I understand it, and it comes with that thinking of optionality. When you learn about convexity, you understand the social aspect too, and the reflexivity of it.
Explain that to a newbie. Explain what you're just saying to a newbie, like
right. So
common biases that people get.
Right. So a great book was Thinking Fast, Thinking Slow, and these cognitive biases are that someone can be very knowledgeable and very educated, and there's all these the crowding bias is where everyone agrees on the same thing and they can't see their faults. Mm-hmm. Right. For example, we all agree, we want the highest market cap companies in our indices weighted, by their market caps because it's done well. We all agree on it, so it can't possibly be wrong.
Yeah.
Right. Another is because a guy he dresses well and he's in a suit and he sounds professional. He must be a good manager. There's all these individual biases people make, and those biases are fine, but the truth is it's random. It's all randomness.
Yeah. So you understand the statistical, like human aspect, basically. I can't remember what book it was, but I think I read somewhere that some of the best managers or the best funds, they actually allocate like a certain percentage of their capital or their revenue or their manpower to literally just tearing apart their strategies. Like, this team, break what we've made. Like that's your only job is.
I love that. You should be looking for faults in everything. Breaking everything. Constantly doing research, constantly learning. But let's keep going. So where was I? This is Garen's volatility hedge.
I would agree on your assessment on this hedge thing too, because I don't think I have used it in many.
Yeah, so it's just, is VIX short-term mean reversionary, and is TLT really a good hedge for stocks? Bonds are the long duration bonds are very similar to tech stocks, right? If you think about a tech stock, their cash flows are very far out into the future. So it acts similarly to a long duration bond. You're not really diversified. You just looked at one specific regime and like that Fed reaction function where everything either V-shapes or they'll just accommodate whatever is occurring. But that's not the normal, or that there is no normal, right? These are different asset classes that can structurally do well in different regimes. So the goal of the Dragon in the first place is to match those 4 different regimes. You know, you got those 4 quadrants: inflation up, growth down, growth up, inflation down, and then both down.
Yeah.
But that, and then you also want to combine the positively and negatively convex. So the positively convex means that it doesn't really make a lot of money most of the time, but it can make a lot, and I explain that. And then negatively convex is like being short vol or the S&P or.
Okay, I see what you're saying then. So for those that haven't seen the actual equity curve of Garen's Advanced Volatility Hedge 2, it's basically just flat. It kind of just goes sideways, and it was designed as like just a hedge, like a place to move your money off of a volatility. But I get where that doesn't align with your philosophy of, you know, if you're going to be in volatility, you want to be convex, right?
I want to be convex, and B, if I already have a certain exposure, I don't really want to repeat that same exposure or that same logic.
Okay.
Right? So it's repetitive.
So that's why you remove this out of your later versions.
Yeah. So you'll see in 5 if we get to it today or not, or I have a new SIMP I'm working on, but the logic section, I basically just said, what are my favorite types of indicators to check for, drawdown, standard deviation, moving averages, whatever it is, to check if the market's weak or volatility is high. And then in those different cases, I'll get long volatility, but in a laddered approach. So instead of just one being triggering all of it.
Side question: what are you going to college for?
Finance, obviously.
Okay. Just making sure. Good. I think that's a good choice. I think
Called quantitative finance. I like to study about derivatives. That's like a side, but we'll keep going.
You got a favorite part of your logic or anything that you really like about this?
About this one, we'll look at the commodity momentum section in a second, but I once read a paper that said if a certain commodity is relatively more volatile than its average, then you should use a farther look back for the trend signal.
I found that as well. Really, really far signals or momentum work well on commodities.
Right.
They're just so slow.
So with trend, I was trying to get the bulk of like the beta of the trend exposure, because arguably trend really is beta nowadays. Mm-hmm. And I mean, you can just track the indices and they're all doing the same thing. It's not that hard to pick what asset's done the best over the past 100 days. They're all going to get into more or less the same thing over time.
Yeah. I heard there's a rumor that Composer's going to be doing nested strategies. So, I think we kind of made them exposed to the idea that we copy and paste a lot of the logic systems, and it gets crazy. So it'd be better to just have a call or a loop.
We've discussed that in the Composer before.
But I think they're working on it, and it'd be nice. So let me ask you this: with the commodities where you go into IEF, would you much rather have an actual logic system there?
Explain again. What do you mean?
So in commodities, if Australia 252-day cumulative returns is greater than IEF, go into IEF versus Australia, would you rather have an actual logic system that's actually it's not just holding straight bonds instead of that?
Yeah, but you can do that already. No, you could just add in the else to add other logic.
Yeah. Do you do that in your later versions, or you just?
I mean, specifically for trend, I nowadays I just use the cumulative return filters. So I'll just sort.
Okay.
But you can do a lot of different things. I like simple. Simple is better, especially like this.
I think all the best strategy designers have realized is you want it as minimal as possible.
Yeah. You start with simplicity and you add complexity afterwards. I think that's the best approach. But this is different developed market equity momentum. This I just took from the original Dragon portfolio on Composer.
Yep.
It's checking the past year's returns, and if it's better than 5-year or 7-year treasuries, it'll get long it. If not, it'll get long the 7-year treasuries for all these different developed markets. So you got Spain, France, et cetera, et cetera. And then commodities is where I think I originally started putting my own logic in this. And I did 2 checks for each commodity. I first looked, what standard deviation trigger for each specific asset, because I said every asset's different. Every asset trades differently. Every asset has a different volatility profile. So, for example, oil, I'll check if it's relatively volatile. And if it is, I'll use a farther look back. So I'll use 90 days. And if it's not relatively volatile, I'll use a shorter look back.
Okay.
I was getting long short some things and then not long short others because just based on what ETFs were available to me at the time.
Are you confident in understanding oil? I've always been hesitant to mess with oil logic because it's just so like it can just drop from a cliff.
Yeah, oil is you're at the whims of God and OPEC. So I don't know.
What's your total exposure portfolio wise on oil?
I think I don't know how many commodities are here, but let's see one.
Looks like a pretty small percentage.
Yeah, it'd be.
You can see your weightings. Go back up to your weightings.
Yeah, so I know the trend section itself is 18, but then the commodity section would be 9%.
So like less than 1% in oil.
Yeah, like 0.9%.
Okay.
To each ETF, but they all have different, right? So it's not just the weightings themselves; they have different standard deviations. So this is way more risky than holding dollar exposure. Or,
yeah.
I mean, uranium and base metals can be pretty, but et cetera, et cetera. But so I check standard deviation, and if it's relatively volatile, I use a longer look back, and if not, I use a shorter look back. But I'm just following momentum. If it's strong, I'll buy. If it's not strong, I'll sell it, or I'll just hold 3-month T-bills. I did the same for nat gas, the dollar, all of them. If you see, they have different standard deviation checks because they're all different products.
Yeah. So what? Explain standard deviation. What's your interpretation like? Because standard deviation is one of those things that's kind of hard to wrap your head around.
Right. So people prefer variance over standard deviation because variance is additive. If you think about standard deviation, you can go up 1% and then down 1%, and you can have a 0, versus variance, which is additive. My standard deviations too. I'm just giving you an example. I'm not saying the math works out, but it's really just the summation of log normal returns over a period.
As in your later versions, like version 3 and 4, and what version are you up to? 5?
5.
Do you lean more towards standard deviation logic or?
Yeah, so I've come to have that as a personal favorite in terms of logic for equities and actually treasuries. So it makes sense to me. I'd rather be higher weight to things when they're less volatile. It's similar to being long gamma, or when you're long more when it's cheaper or when it's think of it as in terms of notional exposure. So when the standard deviation of oil is greater, your value at risk might be 10% versus 5% when it's less volatile. Mm-hmm. So it ends up being a bigger allocation, not just a function of volatility.
Yeah, it's interesting that you have a very different. I love that there's so diverse design philosophy. Like your design is totally different than Derek's, or totally different than Brian's, or totally different than everybody else's, and it's nice to have that robustness.
I think. Yeah.
Okay, let's keep going.
Yeah. So all the commodities are pretty much the same. When I could get short, I would. For like the dollar, for example, I want to diversify between the yen and the euro, which is also not perfect because you have a basket of other currencies that could do well at other times.
Yeah. Another side note too, I would love to sit down and have a call with you where we just dive into standard deviation, and because I understand it like basically like to a very limited degree, but I know I can kind of make it work in logics, but I don't know it and understand it to the extent that you do, and I would like to dive into that knowledge base.
Yeah. So standard deviation is kind of like the speed of the cars on the highway analogy, and if cars are your biggest risk in the first place,
so you're measuring velocity.
Yeah, you're measuring a second derivative.
Okay.
So when you say standard deviation, do you mean the statistical standard deviation, or are you like the bandwidth, or are you talking about how far away it is from the mean?
Yeah, it's just how far the returns are from the mean. That's all it is.
Okay. We can dive into that.
Standard deviation is just a summation of the average log normal returns, right? So it's just the distance from that average.
Mm-hmm.
But the momentum section is pretty simple. It does all the same thing. I just use different checks for each in terms of which standard deviation you use.
Have you considered, in that regard, using the base, the moving at, like, do you use how far the current price is from like a 200-day instead of like an actual proper standard deviation? They're probably pretty similar, but one at least tries to follow the trend, I guess.
Right. So there's probably a lot of different ways of getting the trend exposure, and they're going to end up all looking very similar. You'll have path dependency. So your equity curve could look completely different, but if you look at the exposure itself, they'll look very similar. Eventually we'll try to get rid of that.
I got a question. Would you love to be able to weight off standard deviation to adjust weighting based on standard deviation?
I mean, we kind of can already. I think it would be I kind of do it now with if statements in some newer logic. I'll scale up and down based on the volatility of the markets, but I have to do it manually. So that could be cool.
Do you have you also found, I think most designers have found, there's a standard format or framework for any good strategy where you have a long momentum switch, a short momentum switch, and then some kind of mean reversion?
Yeah, so I think especially with price action logic, your really two main factors are momentum and mean reversion.
Mm-hmm.
The other aspect is just relationships between asset classes.
Yep.
But
arbitrage.
Yeah, exactly. Those are really the options we have at our disposal. And to be honest, those are what everyone does. You're either buying dips or you're buying, what's high. You have two choices. Things are up or down.
So with standard deviation, you could have like a momentum switch that goes into a standard deviation. You said you scale in and out of positions with standard deviation. You can't measure direction though with standard deviation. You're just measuring volatility or expansion.
Right. So that's when you start to understand convexity and option skew. Right. Certain products will have different skews. So the S&P is negatively skewed, which means that when things are more volatile, the risk is to the downside. But for something like oil, a lot of times it'll be symmetrical. A lot of times it'll have put skew, but a lot of times it'll have positively convex call skew. And so when it's more volatile, your risk is to the upside. So in terms of risk reward, I'd rather be long something that has greater upside than downside.
Yeah. Okay. I'm getting ideas, but okay. Keep going.
I just mean that volatility is not always a bad thing for all these things. Just some of these are in essence carry trades with negative skew, meaning they make money all the time, but they lose a lot.
Yeah.
And volatility is a bad thing.
If you could add options into Composure,
yep.
would you? And
yo, what's up, Hassan, by the way?
Hey.
Hassan,
yeah. The question is like, if you could add options into Composure or your current algorithm, would you, number one, and where would you add them?
I mean, we could definitely get into really cool shit if we had options. We could do a whole bunch of dispersion trades, but I don't think Composer would let us short options, so it'd be a little difficult. But yeah, if you really want to get that convex exposure, you're gonna need to trade, either options or options on the VIX, or if you want to get really convex. But I think it could be very cool. I think I'd prefer futures just for the capital efficiency.
Yeah.
And like the delta one, I don't need the convexity of different payoffs, but options would be options. It's too hard to implement though.
Yeah. Do you feel like options, like, can you control can you control the volatility with the options, or you feel like you could? You're essentially wanting to capture the convexity of assets off of options.
Yeah, that's what you're doing. And you can really isolate the volatility of an individual asset, and you're really trading that as an asset class. But at the same time, we're not HFT guys, and we're not managing our Greek exposure on an instant basis.
Yeah. I wish Hinomi was here, because he's got a lot of skill set in signal isolation.
Yeah. No, I find that stuff fascinating. But let's keep going. So, and then the other part is for the commodity momentum section. I just matched it with DBMF and foreign com, which are also trend following ETFs.
Okay. Then you just got you got 19% sitting on gold.
Yeah.
That's pretty high. What's the reasoning?
That was the original drag. If you look at the Dragon paper, that's the allocation they give to gold. So I didn't have any good gold logic, and I didn't even want to complicate things further. I just said, okay, I'm just going to hold gold like they do.
Yeah.
In newer versions, instead of gold for fiat alternatives, I used my inflation spiral section, which is different things that could do well in inflationary regimes and certain logics and certain static allocations. But I use that in complement with trend following. That they both, I personally think you can capture the beta of inflation pretty well.
Yeah. Yeah. If you look at the 1970s, if you look at the historical charts on inflation and when things take off, it's pretty slow, actually. It takes a long time.
And it's sticky, meaning whatever logic you have is going to stay around for a while after it triggers.
Yeah. Yeah. If you do the math on like investing in commodities during the 70s and you compound that with the S&P 500 rotation into the 80s, it's just insane. The profits are crazy.
Yeah, that's ex post. I can't make anything from it. If I put them all together, then I'm set up for success. But if I think I can do one and then the other, I can be a genius or I can be a loser. You know?
So one of the things I see with your design logic is you're very robust, but so for example, TTQ for the long term, it's very singular, very exactly. This is what we're doing.
And it's good at that specific goal, right? I want that exposure, but I don't only want that exposure. And I also don't only want that certain logic.
Yeah. So do you find like applying that singular focus onto, for example, gold or like commodities inflation boom, would you design a logic specifically for that and then implement it into your more bigger rebalancing strategy?
Yeah. So I look at trend, for example, as an ETF. Like if you look at my newer logic, my filters, the 120-day cumulative return, I think of that as a single stock.
Okay.
Whatever it's choosing, I think of it as just a static allocation.
Okay.
Which it helps, you just leave it there. You set it and forget it. You're not changing anything. But
Sandy, if you know me, you know I'm also a big believer in trend following.
Yeah.
One question I had was, have you ever looked into linear regressions? That's one thing I'm currently focusing on. Yeah.
I don't do any form of data science. The research I do is more high level in terms of I like to understand things, but I'm not getting into the nitty gritty.
So in your world, that would just be an extra optimization probably.
Exactly.
Right? Like you're looking at like base level things that kind of work, and then some of these extra things could maybe eke out another % or two.
Right, exactly. And those other things could have a whole bunch of other biases, and ex post looks great. I don't know, like you think about statistics, you have an average. Your average could be really low, but then 99% of the people or of the sample are above that average. So there's a whole bunch of biases you make when you just put a statistic to a certain parameter. But the equity section, I combined two different logics or logic segments. One was from the original adaptive all-weather. And there's a lot of certain repetition. Okay.
Repetition.
Yeah. There's a lot of repetition in the sense that it's checking for bonds being strong in order to get into growth, which I think a lot of us do with our logic.
What Fred data would you like?
Break evens, like inflation break even spreads. I don't know.
Ways to measure inflation and ways to measure better than bonds.
I would love different value spreads, like true value spreads.
So you're getting like a ratio of like different assets, and then
the EBITDA of different sectors. You can just
play in the mean reversion.
It's a factor itself. It's a style premium. You can isolate the value without getting the beta, which is what AQR does a lot of. So you can be long a bunch of value and then short an equal beta amount of anti-value or things that are expensive, like the opposite.
Yeah, I used to do that when I traded crypto. That's what I really liked about crypto is you could weight different from like Bitcoin to Ethereum or Ethereum to avalanche, and then you could see the standard trend, and you just play the weights on the different sides.
Yeah. Okay. So 60-day cumulative return of bonds or strong bond is similar to ag. It's a broad bond market, has lesser duration than something like IEF. And if those are strong, then it'll check if SPY had a drawdown. If it didn't, it'll get long a bunch of levered equity ETFs. I don't really worry too much about this filter because it's picking 4 out of the 5 of them.
Mm-hmm.
Just checking the moving average, and it's hoping for some kind of it's a mean reversionary logic. But and then if SPY did have a drawdown, it'll get into 1x equities. So I think of them all the same. You know, whatever one you pick, RSP, RPV, quality. I don't worry too much about that logic. It makes sense to me. And you're mixing S&P with BTAL, it's not going to look horrible. You know, you're not going to get surprised one day.
Mm-hmm.
And then if bonds weren't strong, or if the 60-day cumulative return of bonds weren't strong, and then we check for a moving average of TLT over the past 2 weeks or 3 weeks. And if TLT was weak the past 3 weeks, we're going to check if SPY was strong. I don't get too much into the nitty gritty, but basically, if bonds are strong, I'm going to want to be longer growth. And if bonds are not strong, I'm going to check if the market's strong regardless and get long, less pro-cyclical beta exposure. So these are like XLP, XLE. You know, these are market segments that can do well in different environments, particularly when bonds are not strong or rising rates.
Yeah.
So producer staples, you're passing your cost to.
Have you looked into any high cash flow ETFs like cows or any kind of?
No, I haven't. No.
Yeah, I think you probably like cows as an alternative because it's they're an algorithmic ETF that looks for high cash flow. I think low debt companies that are going to be recessionary proof.
That's cool. I've never heard of it. Is COW?
COWZ, I think. Cows. I think it's cows. Let me double check.
So another question I had was, why TLT? Is there a particular significance to the 10-year versus?
I don't think you can go wrong with either. I think that tech will tend to look a lot more like TLT than something like SHY, just because tech is like a long duration asset.
Yeah, I'm looking.
If I want to, I'm basically matching the duration exposures together. So I'm not going to check something with 2-year duration with a 20-year duration. I'd rather compare similar apples to apples. Right. If you think of everything being like discounted by a rate and their cash flows are their underlying discount mechanism, I want them to be as lined up as possible. But that's not perfect either. So I wouldn't focus too much on this logic. I'd use it, but I'd use it with others. Right. So I just want to find stuff that works and stuff that makes sense. I also have a problem with the part below where you just have the chance of getting short triple Qs. If SPY's moving average wasn't great, I don't need to get necessarily short in this specific section. I have other sections to do that. And it could just, it's first of all, it's not even equal weight. So if it's going to pick SQQ a lot of the time, and it'll just massively outweigh the other allocations in terms of volatility. But the rest of it is just paired with US dollar. So like I actually prefer UUP over USDU. But I don't really have a reason for that. I think it's that the underlying futures of UUP I think they're a little bit more liquid.
Yeah, I think I lean towards UUP as well. I couldn't remember why, but I didn't really like USDU. Looking at cows though, I looked at the chart. If you want to look into it, it's it only dropped 20% through this crash versus the I think the S&P 500 was like 30 or something. I can't remember.
I'll have to look into it. How much assets do they have?
I'm not familiar. I'm not sure. Just a good alternative though.
Yeah.
All right. Well, we're hitting an hour right now on the call.
Yeah. So we can finish up, but let's see.
Is there any logic that you really like or want to showcase, or you think that like PPC. Did I see TT? Did I see for the long term in there?
Yeah, so 30% of the equity section is for the long term.
Okay.
Yeah. In newer versions, I just use 10% of this, 10% of that, 20% of that, and I do it based on whatever's. It's all volatility based. So I want to get an equal risk allocation to every segment I'm using, or at least try to. The thing is that this equity section is still going to outweigh the other sections.
Mm-hmm.
So it's not perfect, but at least you're less exposed than other allocation schemes you could choose from. Right. So if I'm holding, TQQ, it's still going to outweigh my gold section and my momentum section and all these different things. And so it's going to look a lot like the S&P when it's moving. I don't always want that, but it does historically do a really great job at minimizing drawdowns and volatility.
Mm-hmm.
So yeah, I use TQQ for the long term, which in Golden Dragon, I particularly like that I'm not overusing this 10-day RSI check. I only use it in one section versus other versions. I might have it in 2 or 3 sections. It does really well. I don't have a problem with it. I'd probably want to weigh down the UVXY, water a little bit more.
You could use Vixum. Vixum's a less volatile version.
Yeah, but it's
or
not
even if you want to remove the K1s, just do SPXU or something, SH.
But TQ for the long term is pretty simple. A lot of path dependency, especially with VIX products. So you're checking the relative strength over the past 10 days. And if VIX is really strong, it'll get either long vol or long the market if the market's still strong. But that's pretty unlikely if VIX is strong. So TQ for the long term is, you want me to go through it?
No, you don't have to. I've covered it quite a few times. Anybody that's watching the recordings, I've got previous videos on for the long term with Derek.
Right. Okay. And then the last section is interest rate linked. And I forget where I originally took this logic from, but it's only one logic segment for treasury bonds. So in other versions, I've completely changed that. It does not look anywhere similar, but this is just one specific section that worked to fit my bucket.
This might be Derek's bond logic. I think he was trying to apply for the long-term design or framework to bonds.
So it definitely is similar. It mixes momentum and mean reversion. For example, if TLT is strong over the past 200 days, then I'll just check a bunch of RSIs. If it's too strong, it won't be in TMF. If it's too weak, it will be in TMF. If it has momentum short term, it'll stay in TMF. That's basically what it is. It's not that crazy. It's just a lot of times you'll see some overlapping logic in 2 different sections where everything will trigger all at once. So if I'm checking the moving average of return of TLT in 2 different sections, I can get extra short QQQ without even realizing it.
Yeah.
That's a little bit of my problem with adaptive all weather also. It's not the logic itself that's horrible. It's just the overlap logic and the over allocation.
Okay. So yeah, we didn't even get into that. The reason that you went towards Dragon versus all weather is because the overlap. But don't you want to weight into convexity?
Right. So that's the other thing. It's like the highway analogy. You want to know when it's most advantageous to run out. You want to be aggressive, and but I also don't want it to all trigger based on one specific path. So I'd rather it ladder into the logic because that's whatever it should be, but not because it all triggered on once.
Okay. So you don't want the cluster failure. You want to have diversity in the logic.
Yeah.
Okay.
Which I don't have in Dragon 2. I didn't have in Dragon 3 either. 4 started to be 5 is better. Some new stuff I'm working on is I'm even focusing on more static allocations. Less logic is best. I add a lot of layers to it, but it trades not that often. It's pretty static. I prefer that.
Yeah.
It shows you that you can do a lot with a little.
Be interested to see that version. For the next calls that we do you want to skip 3, or do you think there's stuff in 3 to showcase?
3 is when I first used new trend section. But I think, and I added a new bond logic, which was, I think, the bond logic from adaptive all weather. But 4 encapsulates that, and 5 does too. But 5 has some of my favorite logic I've ever built. It's when I really got into building my own, logic versus a lot of these just reusing others.
Okay. So what do you so you've been designing for almost 6 months now. What do you feel you've learned or like evolved over the months? What pieces of advice would you give to newbies?
Yeah, I would think um, believe less of what you hear or what you see. Definitely come up with your own ideas, and I think start with a top-down approach versus a bottom-up approach. I think come up with whatever your goals or logic that you have some kind of view on, and then you're not fitting the logic to your views or goals. Think of it more of I want to get this and this, and I want them to put them together, so I'm not worried about any single path. I didn't really think too much of an answer for this.
It's okay.
You definitely just read a lot. You have to. I think market relationships, understanding the underlying assets in the first place, are very important. Um,
Yeah, I think a lot of people have a hard time with understanding the different asset classes, the different sectors, the different industries, and then you got the emerging markets and the other commodities, and there's just so many different assets and different things that you can invest in, and they all move differently.
no, it's a very cool time for us. As retail investors, it's never been better. We have so many options. We can get down right to it. It's cool.
Yeah, I definitely enjoy this more than the past 5-6 years of trading and investing. This is actually very enjoyable. And we didn't talk about the pop off on UVXY and like talking about, so for those that are watching this on a recording, a lot of our logic systems triggered to Friday or Thursday because of the S&P 500 RSI was above 70 or 80. So a lot of those logic systems were going into UVXY. A lot of people in the Discord were kind of freaking out and like worried, like what's going to happen. What's your opinion on, adding emotions and adding fear into your logic systems?
Right. Well, VIX is not the fear index. VIX is just a 1-month variance swap. So I don't think 0DT has that much of effect in the sense that it's not really changing the pricing of the options I think VIX is between 27 and like 36-day options, and they're taking a weighted average of all the out of the money and around the money options based on their strike price. So puts will actually have a higher weight but a lower gamma exposure, which means that their deltas grow less as the market goes down. That's just a function because think about it. If you're a $20 stock, you'll have less notional exposure than if you're a $50 stock.
Mm-hmm.
Right? So as it goes down, you have less delta notional exposure. But you're really VIX up, market up, VIX down, market down, VIX is broken, all these things. VIX is a probability distribution, right? That's what you're trading. The fatness of the tails, the speed of the tails, right? I think of skewness as the magnitude of the outliers and convexity as the acceleration of them. So positive convexity is accelerating gains and decelerating losses, and vice versa for negative convexity. And you're trading that. So you're isolating a certain component, and VIX is not perfect itself because it relies on a certain weighting scheme. But I don't think you should be afraid of holding UVXY. I think that you should definitely not be holding only UVXY.
Yeah.
And it's very much a trading vehicle. So I wouldn't have any logic that holds UVXY long term.
Yeah, no, definitely.
For obvious reasons.
Yeah. If for anybody that's looking for an alternative to UVXY, if you look at the VIXM chart, VIXM, it likes to pop and go sideways and flatten. So like you don't have that snap real high and that pop back down real quick. It kind of holds its value a little bit longer. So it's not nearly as snappy if you want something less snappy.
So the nice part about VIXM is that because they're like medium term VIX futures, the carry or the roll cost will be less. They're still going to be rolling the futures every month, but it's not going to add to the drag as much. There's definitely going to be drag, but it's not fractionable. So I tend to not use it nowadays.
Okay. So what about as far as the individual managing their portfolio, were you worried about being in UVXY and yesterday, or And do you ever liquidate positions, or do you trust your algos and let them run?
So I trust my algos, the ones I built, because I actually understand them and I know how they're trading, why they're trading, where they're trading. I know what they're in and when they're in it. But older variations of simps I've made, I'll discontinue because I prefer newer logic I built. But most of the time, it's that I change someone else's logic into my own. So that comes from just an understanding of it. And you tend to prefer certain things over others, right? So I prefer the standard deviation logic nowadays, but that's not the only thing I'm going to use. The other thing is, you would think a lot of these things are price based, right? So we're the number one, the only thing we really have access to choose is price as a gauge. But price is very valuable. Price is all information. It's all encompassing, right? Price, you can get relationships, you can understand volatility, you can understand all these different macro regimes just like based on price alone. So Composer is a very valuable tool. You don't need more. You can get enough with it. Fund flows would be cool. And we've talked about that in the Discord, but it's exciting, man. We're going to build some cool shit this year.
Yeah, I'm very excited. I really want to drive this community forward in what we're doing. Is this the best Discord you've been in?
I don't do Discords really. I don't do it.
That's actually, I looked at the analytics. A lot of people that join the server, this is the first time they've used Discord.
I think that's older people. I think people are using Composer are a little bit. You would think they're a younger crowd, but it's 30 to 40-year-olds.
Yeah, you might be the youngest guy I've talked to.
Definitely up there
with the expansive knowledge that you have on this stuff. Yeah, I think you're going to do fine in finance career.
Thanks. Thank you. It's all about the grind.
Does anybody have any questions for Sandy?
Yeah, I did have a question, Sandy. I know we discussed a little bit about replicating this with futures.
Yeah.
Have you given that any more thought?
Yeah. So I always build things with with the goal of being able to slowly replicate it manually with futures. So I use very simple ETFs that most of them are available in futures also. Nowadays, though, my new bond logic, for example, like you don't have high yield index futures, you don't have mortgage-backed security futures, like agency security. A lot of these things you can't replicate, but I wouldn't. If anyone doesn't know, the reason why you want to use futures is capacity constraints, so you can trade billions of dollars versus millions of dollars just due to liquidity and notional exposure in the future markets. And the other reason is tax efficiency. So when you're trading ETFs, you're turning over ETFs throughout a year, you're paying 100% short-term gains. Versus futures, you're paying 60% long-term and 40% short-term, or it could be vice versa. But those two reasons I'd really love to implement anything as much as I could with futures. You can use ETFs and futures together. It's just about your exposure would be the same, right? It'd be all for advantageous in terms of tax alpha.
Anybody else have any other questions?
Got questions from chat still.
Oh, which ones did we miss?
Let's see. What's the criteria to the point where you consider a strategy is not overfit and can adapt to different kinds, conditions, timings of market?
Right. Whew.
That's a hard one.
Yeah.
What I do is look for.
Yeah, you go first, and I'll go.
What I do is I look at the asset as far back as I possibly can, and then I look at other assets that are similar that I can go back even farther, and I understand the different regimes, like, we're a consumer-based economy. I think I start from a high view, like we're a consumer-based economy right now. It moves, I understand why it moves differently than it did in the 70s and 80s and the 60s and the 50s and the 40s. And then I try to understand other macro, economies like Japan, Brazil, different, like what makes different economies move. Mm-hmm. Then I think, okay, what's going to happen in the future to this asset, and where have I seen that similarity somewhere else? And then I try to design the logic so that it's robust enough to handle that scenario if it does happen.
Yeah, kind of similar. I would have a certain logic, and then I would change it a little bit if your allocation is completely out of whack. Something's wrong, right? So if I change the number from 50 to 51 and it's completely different, you have a problem. the overall logic should be intuitive though. So if I can use 5 different things and it's capturing the same allocation or movement, very similar, then I know it's more about the logic and the intuitiveness of the logic and less about the specific structure of whatever logic you put together. But it is really at the end about allocations, right? So if you can understand it further, if your allocations are slower moving, right, and not as path dependent to the trigger, then I think you can say it's less overfit. And I think certain relationship things can be overfit. So you have to be careful in that sense, right? So I don't know. And the argument is this sort of thing overfit, or it's a different period in time where it's not doing well? And how do we gauge that? And that I think time will tell.
Yeah, that's a complex problem.
It's everything. The truth is everything is overfit. Even the S&P 500, like any allocation you could possibly make, right? It's somewhat overfit in the sense that you're picking things that perform well. It's ex post.
Yeah, we've had a lot of discussions with some of the power users, like, could we build a layer 2 system that on top of our algos where we can turn the algos off and on? Like, are they overfit, or are they like they find like a specific thing that works really well, and then how do we turn those off and on dynamically based on what's happening in the market?
Right. Yeah, but I'd like to go into 4 and 5. But I don't know. I gotta think about how I want to explain it. I think I can get around it to simplify the understanding a little bit.
Well, you got some time. Next weekend, I'm gonna get my ass kicked in a jiu-jitsu competition, my first one, and then I don't know if I'll be doing hosting a call. I'll probably do bi-weekly for now, but I'm gonna reach out to some of the other builders and see if they want to jump on and do some recordings.
Yeah, no, it should be fun.
I would love to have Hanome on, as well as Michael B and a few others. All right, guys, if nobody has any other questions, I think we'll wrap it up. Thanks, Sandy, for
Yeah,
jumping on
thank
here
you.
and
Thank you
walking
guys for
through this.
listening. I appreciate it.
Thanks for being a part of the community too, and your contributions.
Yep, I hope to learn more, guys. All right.
All right. See
Thank
ya.
you. Awesome call.
Thank you guys.
I appreciate it, guys. Good information. Bye.